Hi, how are y'all doing? Hope you're doing well. Um, we're in the home stretch. We only have a couple weeks left. Have two more chapters, one more quiz, and one more exam. Last few chapters are pretty high level. I don't think it's anything that you're going to be overwhelmed by. We're going to talk about some additional alternative risk financing methods. But before we get started, let me share my screen with you all. Okay, let's talk about alternative hazard risk options. So the rising costs of insurance and those unpredictable markets that we're experiencing right now, the insurance market and reinsurance market, especially for catastrophes, as we see more and more wildfires and more hurricanes, those really force organizations to look at alternative methods of financing that they wouldn't otherwise have to look at. Capital markets products are traded just as they would be any other financial instrument, stocks or bonds, and they typically mature in more than 1 year. So they actually have a time frame. Investors know what they're in for and what the turnaround time would be to recoup their investment. These products really have emerged in the last several years as tools so organizations could find out alternative ways to finance the risk. When the insurance market doesn't have alternatives, they have other things to look back on. This really demonstrates the convergence of insurance with other financial services, and that really has expanded the capital market role out in risk financing opportunities. There are three key ones we're going to talk about. First being insurance-linked securities. For short, we call that ILSs. Those instruments have a value that's driven by the insurance events or loss events that occur. Could be insurance or reinsurance. So really they're tied to something bad happening like a catastrophe. And that's what helps it drive its value. Insurance derivatives have a little bit more of a market tradability like you would any other derivative. Those contracts have a value that's based on the level of insurable risks that occur during a specific period of time, whether that be a year or it could be longer or shorter, depending on how the investment is structured. The last one is a contingent capital arrangement. This is in advance of an actual loss occurring. You have an agreement that you establish with another organization who has the funds available to help fund your loss, and you make those arrangements in advance. You know what kind of interest you're going to have to pay, what expectations are, and so it really kind of minimizes your exposure and your uncertainty of what will happen if I have an event. We're going to get into more of the specifics of each of those as we move forward. Let's first focus on ILSs. These are a marketable instrument that's based primarily on cash flows that come from a transfer of insurable risks. So you as an organization, rather than paying insurance premiums to a third-party insurer, a traditional third-party insurer, you're going to use an SPV, a special purpose vehicle, another third party. They will actually collect the monies that you would pay in premium, and in return, they're going to promise to pay you a certain sum of money to cover your losses. So it's very much structured like an insurance policy, making the SPV like an insurer, acting like an insurer. Why would investors want to be involved here? First of all, it's very attractive for them to diversify their portfolio. Most assets are linked and their risks are correlated to market highs and low, interest rate risk, exchange risk, commodity different types of risk. So these particular have to do with the probability that some catastrophe is going to occur. Weather-related incidents don't really have any correlation to markets directly. Now, markets, economies may crash as a result of a bad experience like we're experiencing right now with COVID, but they typically are not correlated that the events immediately going to occur at the same time. Typically, ILSs are in the form of catastrophe bonds. So the SPV is going to take the monies that you've given them. In turn, they're going to set aside these funds, and they're going to sell these the ability for third-party capital investors to put money into these bonds, monies that they would have put into the capital market anyway, and they get an opportunity to get a higher rate of return. If the event that you're insuring, the insurance-linked security, doesn't occur, then the interest and principal would be paid back to the investors just like they would at any other. At the end of the bond term, they would get their monies. If the loss does happen, a lot of times what happens is that the investor actually gets a shorter end of the stick. They don't get all their monies back, and they will actually have to help pay for the loss. The monies that were set aside will be used to cover the loss rather than pay back the interest and principal. So again, they're set up a lot like any other bond, the structured time period. Insurance derivatives, they actually increase in value. So as insurable loss go up, the value of those derivatives go up. That gives the purchaser of the derivative some gain that will help them offset the insurable losses that they need to fund. The buyer of the derivative is accepting some portion of the insurable risk, and in return, they're going to get some higher level of rate of return that's commensurate for the risk that they're taking on. The value of the derivative is very marketable. It's actually traded. It's a lot of times based on an index with that's tied to a specific industry, the level of losses that occur in that industry, or it could be tied to one organization. A lot of these contracts are based on concepts such as swaps, contracts, and insurable insurance options. So a lot of similarities. We'll get into a little bit detail in a few more slides. A contingent capital arrangement is set up where essentially you are agreeing in advance with another entity who has capital to invest that you need monies injected into your organization to help cover your losses. That could be in the form of a loan, or it could be in the form of equity, depending on how that's structured. And we'll get into the different types as we move forward. You're not actually transferring the risk of loss to these investors like you would be with an insurance or a ILS. You are actually saying, in the event something happens, you're just promising to loan me some money or to inject some money into my business to help cover those losses. Why we do these up front is because you get more favorable terms and conditions rather than waiting to when you're in a weakened financial situation and it's all doom and gloom. You want to have that arrangement up front, knowing what you're going to have, what you can get on the market, rather than waiting till the time when everyone is seeking monies to help pay back their losses and you're competing for the capital. So where does the value of these capital market products come from? It's a relatively new market. These markets offer products that investors are really willing to invest and accept the risk because they're going to get a higher rate of return than they would be on a standard bond or certificate of or CD. Products are really useful in expanding the traditional business and managing your financial risk. So when the insurance markets are not available to cover the capital that's needed, the influx of capital, these other investors are putting capital into that market, and it's a new opportunity for them to have new diversified investments. It really allows financial service companies to expand their business by offering these two new types of market and new capacity to their investors. And theoretically, a capital market product could be used for any type of insurable risk, but typically most of them are the catastrophe type exposures. There does involve a great deal of time and money expense to actually implement and underwrite these types of products because of the types of uncertainties that we're dealing with. But again, they have some value when there's nothing else available out there in the insurance market. And most, like I said, are really structured around catastrophe risk exposures. ILSs, or insurance securitizations, are a little bit different than the securitizations that we talked about in the last chapter. Those had everything to do with taking a marketable asset like a receivable and getting a cash out. You basically walk away from that exposure, you get the influx of cash, you don't have to worry about it anymore. In this situation, the SPV or third party is actually acting like an insurance company. You're willing to pay them a premium. In turn, they're willing to pay you if you actually have a loss. They're going to take all those monies that you paid in premium, set them aside in another account to collateralize the loss in the event it occurs. At the same time, they're going to mark up at a specific rate to a third-party investor who's willing to pay for a fee some additional funds to set aside. In return, they'll get their interest potentially back, and that's greater and makes it worth their while. These particular arrangements are fully collateralized. So in the event a $50 million loss occurs, there's $50 million sitting there ready to pay it. Again, you truly are, the SPV is acting like an insurer in that they're taking the premium and they're paying the losses just like an insurance company would. And instead of selling the assets like you did in the regular securitization, you're just paying the cash to the SPV, and they're willing to turn around and sell that ILS to an investor, and they're going to hold on to those monies, and in times when things get bad, they'll have the monies available. If the event occurs, let's say it's a hurricane, that loss threshold is met, the SPV would actually reimburse you, the organization, for your losses up to a limit that you've set up in advance. At the end of the period, they may withhold from the investor. Let's say you actually have that loss. They don't have to pay all the interest and principal back. It really depends on the arrangement. Now, if the entire period passes, let's say it's a 1-year ILS, and no losses occurred because it's a low probability and it's a low likelihood, they would then have to go ahead and pay back the principal and interest to their investors. So investors have a pretty strong probability of getting their rate of return back, but they're also taking risks that it might actually occur during the period that they hold it. These securitization transactions really do mimic the traditional insurance market risk transfer because you're actually trading and transferring that risk to a third-party SPV who in turn is agreeing to indemnify you or pay you back for your loss. Key difference in the role of an SPV compared to other types of securitization. The SPV here is actually taking an insurable risk because they're actually creating that insurable arrangement where you're giving them a premium and they in turn promise to pay you for a loss, and they're turning that into an investment risk to a third-party capital investor. They receive the cash from both sides of the transaction, both from you as well as the investor, and they take and turn that into an insurable risk. They're holding onto that collateral, fully collateralizing the loss, and they're agreeing to repay the interest and principal in the event no losses occur. If the loss occurs, then they're going to have to agree to pay you for your exposure. A lot of times SPVs will actually qualify as an insurer or a reinsurer. Just depends on where they're domiciled because it very much is like an insurance agreement arrangement. As I mentioned earlier, most of the ILSs are set up like catastrophe bonds. So in theory, you could take an insurance securitization and make it apply to any insurable risk, but most of them are typically structured for catastrophes, specifically designed to transfer catastrophe risks that you as an organization have to third-party investors that have capital to put into the market. These were developed in response to limited availability of market or insurance products out there, or because catastrophe reinsurance is becoming so expensive and they needed more capital invested into this arena. Some of the issues that the catastrophe bonds cover would be like a hurricane, earthquake, any adverse weather event, environmental risk could be an exposure like an oil spill. A lot of times they're triggered by a loss that occurs over a period of time. Maybe they have so many events, or it could be one single event occurrence that could be a very large hurricane or a large Cat 5 tornado. Most of them are structured to cover those really high expected loss, but really low probability. So 1 in 100 year event, 1 in 200, 1 in 500 year event. Don't happen very often. The values that are structured on these catastrophe bonds are much higher, at least in excess of 50 million. And there's usually a good loss data available to help analyze the exposure. What are the investment benefits to the investors? Well, first of all, it's different from any other investment that they typically put their money in. They're typically investing in an organization, their stocks, and they're relying on the effectiveness of the business, the creditworthiness of the business, how well it's managed. In this case, the only thing they're really ensuring is that a probable event or low probability event's going to occur, and it's easier to tie to it's a 1 in 500 year flood event or a really low probability of having a Category 4 hurricane hit in one particular region during a period of time. There's really a low level of correlation between traditional investments like in the stock market that are tied to stock market movement, interest rate, commodity rate risks, or a market risk involved with pricing. So it does give them some diversification. And a lot of these new investment structures really have gained acceptance by investors, and there has been a secondary market created as a result. Rating agencies actually score their credit worthiness just like they would any other organization, rating their ability to pay back. It's basically a credit rating. And then a lot of these new types of securities can actually be used to help invest in mutual funds, pension funds. So that gives a little bit more diversity to different portfolios. The disadvantages of these ILSs is they do create additional risk transfer capacity. Advantages are they do create some additional capacity that's not available in the insurance market. So when they've run out of alternatives in the traditional markets, they can come to this particular market and gain some more capital. There's a lot lower level of credit risk, so they're not really worried about you paying them back. The monies are set aside fully collateralized by the SPV. They don't have to worry about whether you're going to come through because you've already paid the monies up front. It does provide some secure resources to them. Really, the only thing that they're taking a risk on is the probability that a specific catastrophe may or may not happen. And the financial security is really believed to be higher than that from a traditional insurance transaction, because in most insurance transactions, insurers only pay set aside a small fraction of the total policy limits they set aside. So only a small percentage is collateralized, where in this instance, there's a lot of financial security because they're fully collateralized. Disadvantage is that there is exposure to the market volatility. There's no guarantee that it's going to be an effective risk transfer. Really depends on the state of the market. So when the market is soft, they're going to get less rate of return for their capital they're investing. They're more likely to invest when it's a hard market and the prices are higher. There's an opportunity cost that instead of putting money in this, they could be putting it elsewhere in other assets. So the good thing is this particular investment has fully collateralized, there's less financial security. May be a higher cost, but you have more financial security as a result. There are a lot of transaction costs associated with an ILS, and one term that you may have not heard but want to make sure you know for the test is basis risk. Basically saying that the amount that you need to cover a loss may or may not be offset by what you actually incur. So that can occur in any financial transaction. So you may get less than what you actually need, or you may get more than what you actually need. It's really hard to know what your total exposure is in a particular catastrophe. I'm going to cut it off there, and we'll do another short video soon to continue the rest of the chapter.